Both September as well as October, they have special places in finance. And today I'm going to go through a bit of history in order to try to put some light in what's going to happen in the future. Now remember, past performance is not an indication of the future, but let's go dive a little bit deeper into the past of both September and October. October, more than September, has had a special place in finance, known as the October effect, and is one of the most feared months in the financial calendar. So let's have a look to see whether there's any merit behind the fear. Now, the events that have given October a bad name span over 100 years. So let's take the key takeaways. The October effect refers to the psychological anticipation that financial declines and stock market crashes are more likely to occur during this month than any other month. The bank panic of 1907, the stock market crash of 1929, and Black Monday 1989, they all happened during the month of October. So, historically speaking, however, September has had more down markets than October. However, I like this key takeaway. The psychological effect that causes some traders to blame October for stock market declines may actually make it one of the better buying opportunities for contrarian investors. Now, if you're new to this channel, you might know it, but I consider myself a contrarian investor. Just as Warren Buffett, he says, be fearful when others are greedy and be greedy only when others are fearful. But first of all, I want to welcome you to Crypto Never Sleeps. And in case you're new to this channel, you want to stay on top of the crypto world, well then please hit like, smash, subscribe so that you can be notified every time we upload new videos. And this is important so that you can protect your wealth, preserve your wealth, and ultimately also increase your wealth. My name is Nico Arachi, and I'm the host of this little show. Let's start with the bank panic of 1907 in October. What was it exactly? Well, it was a financial panic that threatened to engulf Wall Street, mostly owing to threats of legislative actions against trusts and shrinking credit. The panic started in October 1907 and it did stretch for 6 weeks. Now, during this time, there were multiple bank runs and heavy panic selling at the stock exchanges. All that stood between the US and a serious crash was, thank God, a JP Morgan-led consortium that did the work of the Federal Reserve before the Federal Reserve existed. Now let's jump into the second one, stock market crash of 1929. The crash of 1929, which began on October 24th, was a bloodletting on an unprecedented scale because so many people had money invested in the market. In fact, it left several black days in the history books, each with their own record-breaking slide. The third one, Black Monday. Nothing like Black Monday, or maybe Cyber Monday. Nevertheless, nothing says Monday like a financial meltdown and an unexpected stock market crash. On October 19, 1987, which historians now refer to as Black Monday, automatic stop-loss orders and financial contagion gave the market a thorough throttling as a domino effect echoed across not only the US, but the world. You see, at that time, the Federal Reserve and other central banks did intervene, and they were able to recover both the Dow Jones and main indices around the globe in a very, very short time. The Dow dropped 22% that day, but thank God to the intervention of those lovely, lovely central banks around the world. Now, oddly enough, these were all big events that happened in October. But the funny thing is, October is kind of taking the blame for September. You see, September and not October has actually more historical down markets. And more importantly, the catalyst that set off both the 1929 crash and the 1907 panic happened in September, or for that matter earlier. And the reaction was simply delayed. You see, in 1907, the panic nearly occurred already in March. And with the tension building over the faith of the trust companies, it could have happened in almost any month. However, the 1929 crash arguably began when the Federal Reserve banned margin trading. And they did do that in February already, and that's when they also cranked up the interest rates. So taken as a whole, you could say there's a very strong argument that can be made for September being worse for the market than October. So as you can see from the number of black days occurring in the month. Now the original black day, you see, most Americans, analysts and financial engineers associate Black Friday with the day after the Thanksgiving holiday, a day when retailers offer huge discounts and consumers kick off their holiday shopping. But the original Black Friday on September 24th in 1869 was anything but a happy holiday. You say Jay Good, or Gout, I don't know how you pronounce that fella, and other speculators, they tried to corner the gold market, working with an insider at the Treasury. See, the price kept rising until the Treasury broke the corner by selling USD 4 million in government gold, dropping the price of gold by $25 in a single day, sparking a catastrophe crash and ruining many speculators. This was the original Black Day. Now, Black Wednesday occurred on September 16, 1992, when George Soros was raiding on the British pound. This September event is considered infamous by people outside the Forex community. However, within the Forex community, it's revered as one of the greatest trades ever made. I can only concur to that. Soros reportedly made $1 billion profit on that specific deal. But the British government, they lost billions trying to shore up their currency, leading up to the eventual capitulation. Further days in September, and here we got 2001 and 2008. The single day point declines in the Dow that occurred during September 2001 and 2008 were bigger than Black Monday 1987. The former owing to the attacks on the World Trade Center, and the latter to the subprime mortgage meltdown. Now, the 2008 plunge went far beyond the US economy, trimming $1.2 trillion from the global economy in one day. Now, I like to refer to October as an angel in disguise. Surprisingly, October has historically been the month to end more bear markets than it has to trigger new bear markets. The fact that it is viewed negatively may actually make it one of the better buying opportunities for contrarians, just like myself. Now, the slides in 1987, 1990, and 2001 and 2002 turned around in October and began long-term rallies. And particularly, Black Monday 1987 was one of the greatest buying opportunities in the last 50 years. Now, famous investor trader Peter Lynch, among others, took this opportunity to load up on solid companies that he had missed on the way up. When the market recovered, many of these stocks shot up to their previous valuations, all-time highs, and a select few even went far beyond. I actually think the October effect is unjustified. October gets a bad rap in finance primarily because so many black individual days fall in this month. It's nothing but a psychological effect rather than anything to blame on October. Remember, October is a lovely month with Halloween. See, the majority of investors have lived through more bad Septembers than Octobers. But the real point is that the financial events, they do not cluster at any given point. The worst events of 2008 and 2009 financial meltdown happened in the spring as we were seeing the collapse of Lehman Brothers. You see, stocks, they tend to fall in November and December, but that's not due to any individual events. That's just due to year-end and rebalancing and tax optimization. Now, although it would be nice to have financial panics and stock market crashes predetermined in our calendar, and if they even would restrict themselves to only 1 or 2 particularly months, wouldn't that be lovely? However, October and September is no more prone to bad times than the other 10 months of the year. Now, before we end, I would like to give my view on what's going to be in September and October. First of all, I completely agree. Neither October nor September should be blamed for being bad months. What I do think we should look at, that is that we are currently seeing a traditional financial market in an environment where we have had a health crisis, where we have been on vacation, basically forced vacation for the past 2 years. I do believe, and I've said that many times, that a financial global meltdown, for that matter, a financial depression is inevitable. I think we need to see the stock markets crash. I don't believe that the valuations we are seeing, they are in line with the economy that we are seeing. Furthermore, I do think that the current monetary system that we have been experiencing for the past 100 years is nothing but a bad, bad fairy tale. It is funny that in a world today that we don't get educated about the monetary system. But what is even more funny is that we are trying to analyze, evaluate an economy that doesn't deserve fundamental, pragmatic valuations. You see, in one sense, it's unbelievable that we are seeing the stock markets at all-time highs, on a daily all-time high, when we know we have an economy that is on vacation. But on the other hand, unfortunately, the unfortunate reality, of course we are seeing one high after the other. You know why? Money supply and growth go hand in hand. The more money we're going to print, the higher the stock market will go. Very basic, very simple. Welcome to the world of finance. Yeah.